Look at today's date on your screen. Wednesday, December 31st, 2025. We're standing at the edge of something unprecedented, and most people have no idea what's about to unfold. In just 36 hours, when the sun rises on January 2nd and the holiday celebrations fade into memory, a seismic shift will reshape global commodity markets forever. The China export ban becomes active law on that day, but here's what you need to understand. The devastation isn't waiting until Thursday to arrive. It's already happening, unfolding in real time across trading floors, industrial boardrooms, and vault facilities around the world. What we've been witnessing over the last 48 hours represents something far more severe than a typical market correction or adjustment. The global silver market has fractured into three completely separate realities, each operating with its own pricing mechanism, its own supply dynamics, and its own level of desperation. If you're checking the price on your banking application or scrolling through standard financial terminals, you're seeing only one version of reality, and unfortunately, it's the least accurate one. You're watching a ghost dance across your screen while the real action happens in physical vaults and manufacturing centers thousands of miles away. The first reality exists in Shanghai, where panic has transformed into calculated urgency. The Shanghai Futures Exchange concluded its final trading session of the year with silver priced at an equivalent of $84.55 per ounce. This isn't speculative positioning or algorithmic trading. This represents the actual price being paid by the manufacturing capital of the entire world, paid by entities that transform raw silver into solar panels, electronics, batteries, and countless other essential products. These buyers are front-running the impending ban with the kind of aggressive purchasing typically reserved for wartime scenarios. They're securing inventory at any cost because they understand that in 36 hours, the doors lock, and access to additional supply becomes a bureaucratic nightmare involving government licenses, diplomatic channels, and potentially impossible timelines. The second reality operates in the Middle East, specifically throughout physical markets in the United Arab Emirates and Dubai's traditional precious metals souks. Confirmed transaction prices in these markets are averaging $79.61. This represents what might be called the honest physical market, a place where buyers and sellers meet face-to-face, where actual metal changes hands, and where premiums reflect genuine supply-demand dynamics. This market isn't experiencing the total panic visible in Shanghai, but it's tight, constrained, and demanding substantial premiums. The critical detail here is that even outside the direct export ban zone, physical silver trades nearly $8 higher than the paper spot price that dominates financial headlines. Then we have the third reality, the one most people consider the official price. The COMEX spot price in New York currently shows silver trading at $72.15. Now, let's examine what these numbers actually tell us. Shanghai pays $84.55. New York shows $72.15. That creates a spread of $12.40, representing a premium of 17.2%. Anyone with basic knowledge of commodity markets should immediately recognize how impossible this situation is. In any functioning global economy, a 17% spread on a fungible commodity like silver violates the fundamental laws of market physics. When your screen displays $72.15, recognize it as a fiction. It represents the price of a paper contract that nobody actually wants to own. The real world where factories operate, where solar panels get manufactured, and where strategic reserves get built, that world trades at $84.55. The fact that paper markets lag by $12 demonstrates that the COMEX has lost its role as the global price setter. It's become a price suppressor, and the physical market has decided to simply ignore it entirely. Remember yesterday's trading activity when out of billions of paper ounces traded, only 69 contracts stood for delivery, representing a mere 345,000 ounces. That pathetic number seemed to confirm that the market was purely speculative, disconnected from physical reality. Today changes everything. Preliminary delivery notices for the December 31st session show an explosion to 1,847 contracts demanding physical delivery. When you multiply that by 5,000 ounces per contract, you arrive at 9,235,000 ounces demanded in a single day. Compare yesterday's 345,000 to today's 9.2 million. This 26-fold increase in physical demand isn't a volume pickup or a statistical anomaly. This is a coordinated raid, a panic event where nearly 2,000 large entities, banks, investment funds, industrial giants, looked at their calendars, saw January 2nd approaching like a freight train, and simultaneously hit the delivery button. Think about this from the perspective of sophisticated traders. They can use existing paper contracts to demand delivery at $72.15. If they successfully extract that metal from the vault system, they instantly possess an asset trading at $84.55 in the real world. They're essentially buying dollars for 85 cents. It represents the trade of a lifetime, but only for those who secure the metal immediately. This 26-fold spike in delivery demands is the system attempting to violently correct itself, the sound of paper shorts getting trampled in a stampede toward physical possession. This explains precisely why the banking system is screaming for cash, why the Federal Reserve was forced to intervene again today. The banks aren't just losing money on the spread between paper and physical prices. They're hemorrhaging cash, trying to settle these physical deliveries, and the bleeding shows no signs of stopping. While everyone focuses on New Year's Eve countdowns and holiday celebrations, a massive liquidity operation happened quietly in the background. The Federal Reserve's balance sheet from this afternoon reveals terrifying developments. That $3 billion injection from yesterday wasn't a one-time event, a singular band-aid for a temporary problem. The wound isn't healing, it's hemorrhaging. Stress fractures are appearing in individual bank reports. Whispers from trading desks suggest JP Morgan quietly increased loan loss provisions for its commodities division by $400 million overnight. You don't provision $400 million for a rainy day. You provision it because you know a storm is hitting your portfolio right now. They're bracing for impact, recognizing that silver positions they hold have turned toxic. Reports from Citibank insiders describe unprecedented physical delivery requests, clogging settlement systems. They're delaying, stalling, telling clients requesting their metal that processing requires administrative time. Administrative time is banker code for we don't have the silver and we're scrambling to find it anywhere. Consider the timing of this liquidity drain. New Year's Eve typically sees quiet repo markets. Banks want to close their books and go home. For the Fed to be this active, for banks to be this desperate for cash on December 31st, tells you the panic is acute. They cannot wait until January the 2nd. They need money now. This $5.8 billion bailout represents invisible evidence of the crash. Your screen says 72, suggesting everything is calm, but the Federal Reserve's balance sheet says $5.8 billion, which tells you the building is on fire. They're using money hoses to spray down flames so the retail public doesn't see smoke. But the smoke is there if you know where to look. While banks burn cash in New York trying to patch holes in delivery obligations, the situation in Shanghai has accelerated from a vacuum operation to total depletion. Yesterday's 41 tons seemed significant, but updated numbers from Shanghai vaults today show the drain speed has doubled. The Chinese aren't just taking metal, they're gutting the exchange. The mathematics of depletion suggest there won't be any silver left to fight over by February if current rates continue. To understand this burn rate's significance, consider that the Shanghai exchange typically sees withdrawals of maybe 2 or 3 tons daily during normal trading. Current withdrawals exceed 42 tons per day, representing a 1,400% increase in physical offtake. This isn't industrial consumption. Factories don't suddenly need 14 times more metal overnight to build solar panels. This is panic hoarding. This is smart money in China looking at the clock, seeing 36 hours remaining until the January 2nd export ban, and deciding to drain the swamp completely. Their actions are screaming at us. By withdrawing 84 tons in 2 days, they're announcing they expect the supply chain to freeze completely. They're engaging in preemptive logistical capture, securing atoms before politicians secure borders. This creates a terrifying feedback loop for the West. Every ounce leaving Shanghai vaults is an ounce that can never be arbitraged back to London or New York. It's permanently removed from the global float. Western banks, the ones we discussed who are short millions of ounces, are watching this inventory drop and sweating bullets. They were counting on that metal, hoping China might export some silver to cool down global prices. But China is doing the exact opposite. They're locking it down. This 84-ton vacuum is the physical manifestation of the price split. Why is silver $84 in Shanghai? Because only 727 tons remain and everyone wants them. Why is silver $72 in New York? Because nobody believes the COMEX has the metal anyway, so the price is just paper fiction. We're watching an inventory crisis unfold in real time. 84 tons in 48 hours. That's the statistic that matters. Not technical indicators, not chart patterns. Physical drain. Because you can print money to bail out banks, but you cannot print 84 tons of silver to refill vaults. This hoarding isn't just happening at the exchange level, it's trickling down to the corporate level. The panic has spread from state vaults to factory floors. Major industrial players, companies you know as household names, are starting to panic buy. They're realizing their just-in-time supply chains are about to become not in time. Reports involving Samsung and Tesla confirm the industrial panic is no longer theoretical. It's boardroom reality. For the last 20 years, the entire global manufacturing system has operated on a philosophy called just-in-time. It's beautiful when it works. You don't hold inventory. You don't pay for storage. You order exactly what you need for this week's production, and trucks arrive at loading docks exactly when assembly lines need materials. It's efficient. It maximizes cash flow. But just-in-time has a fatal flaw. It relies on the assumption that you can always get what you need at the price you expect whenever you pick up the phone. Let's discuss those Chinese solar giants. China controls 80% of the world's solar panel production. New TOPCon solar technology uses 50% more silver than old panels. What do you think Chinese solar manufacturers are doing right now, 36 hours before their own government locks down the export market? They're vacuuming domestic supply. They're the ones standing for delivery on the Shanghai exchange, ensuring that while the rest of the world starves for silver, China will have enough to dominate the energy transition for the next decade. This is strategic resource capture disguised as a market rally. But the disconnect between paper prices and reality isn't just happening in corporate boardrooms. It's happening on Main Street, at local coin shops, on major online bullion dealer websites. If you think silver's price is $72.15 because that's what the ticker says, try buying an ounce for $72. Go ahead, you can't. We're seeing complete decoupling of street prices from spot prices. Premiums right now are the only honest price signals left in Western markets. Want to buy a US Silver Eagle, the standard government-issued bullion coin? You're not paying $72. Current premiums on Silver Eagles have exploded to over $12 above spot, putting the real acquisition price at roughly $84. Does that number sound familiar? It should, because 84 is the exact price silver trades at in Shanghai. See the convergence? Paper prices in New York say 72, but real prices in Shanghai are 84. And real prices at your local dealer are 84. The market has already repriced silver. The only entity that hasn't admitted it yet is the COMEX. The physical market, whether it's a factory in Shenzhen or a coin shop in Texas, has unanimously decided silver is worth $84. The $12 premium isn't a surcharge. It's the difference between fantasy and reality. Canadian maples usually trade at $2 or $3 premiums. Today, they're commanding $10 premiums. Even generic rounds, basic lumps of silver with no collector value, are trading at $8 over spot. Usually generics trade for 90 cents over spot. An $8 premium on generic silver represents an 800% increase in physical acquisition costs. This is the market screaming at you. Dealers know they can't replace inventory at 72. They know if they sell you a coin today, they might have to pay 80 to get it back next week. So they're pricing in the future, pricing in the shortage, effectively telling you the spot price is fake. If you want this metal, you pay the real price. Reports indicate supply chains behind dealers are starting to freeze. Major wholesalers who supply companies like APMEX and JM Bullion are halting sales, pulling inventory off websites. You'll see out of stock or alert me buttons appearing everywhere. Or worse, pre-order, estimated shipping in 6 weeks. 6 weeks is code for we don't have it and we hope we can find it before you sue us. Put it all together. Samsung buying 6 months of supply to keep factories running. Tesla scrambling to secure critical inventory, Chinese solar sectors draining Shanghai vaults, retail markets charging $12 premiums to let go of single coins. This is total rejection of paper prices. The entire world, from billionaire CEOs to small-time stackers, is voting with their wallets, and their vote says silver is worth 84, not 72. The only people still trading at 72 are high-frequency algorithms on the COMEX who don't have to take delivery. But as we saw earlier, even paper traders are starting to demand delivery. Even they're trying to cross the bridge into the physical world. But the bridge is burning. This industrial panic is the final nail in the coffin for the suppression scheme. You can manipulate charts and sentiment, but you cannot manipulate a factory that needs silver to operate. When Samsung needs metal, they pay the price. Period. When enough Samsungs start paying the real price, the COMEX breaks. The paper market becomes an empty shell, a museum exhibit of a failed pricing model. We're 36 hours away from the official start of the new world. But looking at these premiums, looking at these corporate panic buys, it's clear the new world is already here. The price has already reset to 84. The paper market just hasn't updated the scoreboard yet. But on January the 2nd, when markets reopen and the export ban is law, the scoreboard is going to change, and it's going to change violently. Let me walk you through exactly what happens in the next 36 hours. We have 12 hours left before markets close for the holiday. Then we have 24 hours of darkness where the banking system will try to reset. Then Thursday morning arrives. The Silvergeddon forecast tells you exactly where prices go when the opening bell rings on a market with 0 Chinese exports and $12 premiums. The countdown is almost over. Thursday is when industrial panic goes into overdrive. This is when CEOs of Samsung and Tesla make phone calls to refiners. This is when off-market deals happen. They'll be bidding for metal in the dark, paying premiums that would make your head spin just to secure supply before markets reopen. We won't see these prices on charts, but we'll feel them Friday. But price isn't the danger. The danger is force majeure. Watch news carefully Friday morning. We'll start seeing notices from smaller bullion dealers and perhaps some industrial suppliers declaring force majeure, a legal term meaning unforeseeable circumstances prevent us from fulfilling contracts. It's the polite way of saying we defaulted. They'll tell clients we cannot deliver your silver because China changed the rules. They'll offer to settle in cash, saying here's your $72 back. But clients don't want 72. They want metal that's now worth 84. This is the moment class action lawsuits begin. This is the moment the paper market loses all credibility. We are witnessing the final transfer of wealth. For 40 years, wealth has been stolen from physical holders by paper shifters. They use leverage to suppress prices and keep real value hidden. But in the next 36 hours, gravity takes over. China has removed the physical buffer. The Fed has exhausted the liquidity buffer. Industrial buyers have exhausted the inventory buffer. There are no buffers left. There's only the naked truth of supply and demand. This is the final message before the new year. Don't look at red candles and feel fear. Look at them and feel pity for people selling real assets for paper currency being printed by the billions to cover bank failures. You're on the right side of the trade. You're holding the asset that Samsung needs, that Tesla needs, that China is hoarding. You're holding the asset that cannot be printed, cannot be hacked, cannot be defaulted on. The era of paper silver ends tonight. The era of strategic silver begins Friday. The 36-hour countdown is running. Hold fast, stay safe, and get ready for the repricing of a lifetime.